Hi there, welcome back to another episode. In today's session, I'm going to show you how an equity trust client by the name of John funded a fix and flip real estate transaction. He made nearly a $9,000 profit in 8 to 9 months for a 13% annualized return on investment. And John served completely as a passive investor in the transaction with a first lien mortgage on the property. John wasn't involved with the contractors or the permits or rehabbing the house himself. You'll learn that John was able to secure these profits completely in a passive manner. And oh, by the way, the $9,000 in profit flowed back into his self-directed retirement accounts, and he paid 0% tax in the year in which he conducted the transaction. So let's describe for you how this all worked. Well, step one, John found an investor in his local community that needed funding for a fix and flip project. John knew the market, he knew the investor, he did all of his due diligence on the individual property as well as the investor that he was loaning money to. John made a $100,000 loan to this investor for the fix and flip project. Now, a key element here to understand is that John partnered his Roth and his traditional account together to fund the $100,000 loan. So John loaned $65,000 from his Roth and $35,000 from his traditional. It was a 65-35% split. The $100,000 was sent from his equity trust self-directed accounts directly to the title company for the closing. So the borrower bought the property using the funds from the self-directed account. There was a promissory note and a mortgage. John worked with his attorney to draft this promissory note and mortgage. The lender was his self-directed accounts. The borrower was an LLC, and the borrower, the manager of the LLC, was an individual that John knew in his local community that had professionally fix and flip properties for a number of years. So John made a $100,000 loan to this borrower. They used the $100,000 for the purchase and rehab of this property. And then in 8 to 9 months, the property sold. So the borrower at that time paid back John's self-directed Roth and Traditional, the $100,000 principal, of course, and then the interest profit. Now, the interest profit was about $8,700. So if you do the calculation, that's about a 13% annualized return. As the property sold in prior to 12 months, it sold in 8 to 9 months. Now, that profit flowed back into each of the respective accounts. 65% of the profits went back into John's Roth, and 35% went back into his traditional. So it's important to understand that you can potentially partner multiple accounts together, and then the interest and principal flows back in proportionally. Now, in this case, both of the entities, traditional and Roth, are tax-deferred and tax-free accounts. So in the year in which that profit came back in, John paid 0% tax, no interest income tax. Remember that interest income is subject to one's ordinary income tax rates. But in this case, when John files his tax return, he doesn't have to declare that $8,600, $8,700 in profit that went back into his self-directed accounts, because those monies are going to continue to grow tax-free in the Roth and tax-deferred in the traditional. In other words, in this case, if we compare this to had John done this deal outside of his self-directed accounts, John would have paid anywhere between $2,500 to $3,000 in taxes. In other words, John saved $2,500 to $3,000 in taxes on that one individual transaction. So that's $2,500 to $3,000 more in investing power in cash that he has in his self-directed accounts that he can use for future transactions. Folks, when you begin to compound this year over year over year, tax-free or tax-deferred in a traditional account, I like to refer to this as compounding interest in the absence of taxation. So in recap, John found a borrower that needed financing for a fix and flip project. John loaned money. John had a promissory note and mortgage that was drafted by his attorney. A title company closed on the transaction. John had a lender's title insurance policy as well. The mortgage was filed with the county recorder, so John knew he was in a first lien position, meaning if the borrower stopped making payments or stopped responding, John could pursue foreclosure. So he had a first lien position on the property. Very, very important you work with an attorney, title company, other parties involved in a real estate closing that are imperative to securing your transaction. So that's exactly what John did. And then when the check came back from the title company upon the sale of the property, that check went directly back to Equity Trust, John's custodian, and was deposited into his traditional and Roth. Again, 65% into his Roth, 35% into his traditional. Now, could John have done the transaction 50-50 or 80-20? Certainly, it just depends on the monies that are coming from the respective accounts. John could have, even in theory, his wife also has self-directed accounts, and John also has a self-directed HSA, so in theory, he could have partnered multiple accounts together within his family. He just has to make sure that all profits flow back in proportionally. Now, last but not least, I mentioned John was a completely passive investor in this transaction. In fact, you'll learn that John, he never even stepped foot in this property. What John required his borrower to do is send to him on a bi-weekly basis a video walkthrough of the entire property to make sure that progress was being made on the rehab of the property. That's one of the, call it due diligence, or one of the controls that John puts in place when he's lending money from his self-directed accounts or outside of his self-directed accounts to borrowers. Now, John, he's a busy professional. He travels all over the country, speaking at all kinds of seminars and conferences. And so John doesn't have time to drive by that property every 2 weeks. So whether he's in Texas or Florida or California or Idaho or Washington State or wherever, he gets a video and an update from that borrower every 2 weeks to monitor his transaction. So as a completely passive investor, John was able to loan $100,000, make about $8,700 in profit for a 13% annualized return on investment, and that profit flowed back into his accounts, and he paid 0% tax. And then again, he was able to put that money into future transactions and continue to leverage compounding interest in the absence of taxation.